wrap up this week. This is assignment handout 2.1, and you start off with crossword puzzles, which are really kind of fun. It's just a vocab. On the where is it? Here on the template that I've provided, simply fill in. You can just click in each one of the cells and put a letter in there and spell things out. You'll have to use the template or the handout as a guide for the numbers, because when I removed all of the lettering that was in there, obviously it took away the number system. So you'll have to use this as sort of a template to the template, I guess. Next up on this one, 2.1, we've moved into brand new territory. And I hope you've watched the videos, the concept videos, because they're going to help you tremendously. They're going to explain debits and credits. And debits and credits are nothing but increases and decreases. Just like we've been doing when we were in 1.2, where we're doing transactions that increased one side and decreased the other side. That's all debits and credits are for. And a debit is the left-hand side of an account, and a credit is the right-hand side. So just keep that in mind, and please listen to those videos because they're very good, especially the first one about how debits and credits work, the rules and regulations, or the rules and guidelines. So let's look at this. We're going to look at a company's accounting equation. And it gives you the numbers. The revenues are 460. Well, we start way up here, I guess. I'm sorry. At the end of the year, Jane has had a total assets of $300,000 and liabilities of $220,000. Well, you know that's the accounting equation, and you know you're going to have to find the owner's equity for that. Then we move on to the revenues. And it tells you revenues are 460 and expenses were 380, and then it asks you to find the net income. So if we move to the, I'll find it here in a minute. Just be patient here. How about that? No, I still haven't got it. Oh, that's annoying. Here we go. Now we have it. Now, it wants you to say whether this asset is a debit or a credit, this liability is a credit or a debit, or owner's equity is a credit or a debit. Well, the assets are, what did they tell us? $300,000 for the asset, I believe. And, is that right? Yes, $300,000. The liability was $220,000. So, what does that make your owner's equity? That becomes a question. So you know how to find that. You take $300,000 minus $220,000. That gives you owner's equity. The question becomes now, is this a debit balance? Is this a debit or credit? So we know assets. If you remember the video, it said assets are on the right side of the equal sign and the left side of the equal sign. Boy, I about messed you up really bad. And if an account is on the left-hand side, it has a debit balance, right? So if I look over here and I look at liabilities, I'm now on the right-hand side. And a credit is a right-hand balance. So that would mean our liabilities have a credit balance and our owner's equity have a credit balance. See how that kind of works? The next one is revenues. And they give us revenues of $460,000 and expenses of $380,000. And we know revenues minus expenses equal net income. So you have to do the calculation for that. The question then becomes, is revenue a credit or a debit? Are expenses a debit or a credit? And what is net income? Well, if you remember way back, about 3 or 4 hours ago, we said there are only 4 things that can affect owner's equity. Net income and net loss is one of them. So if this has a credit balance and net income increases owner's equity, what kind of balance does a revenue account have to have? If it wants to increase, if I want to increase an owner's equity account, I credit it. That means my revenues have to have a credit balance. Okay, if expenses subtract from revenues, they would have to have, obviously, what? A debit balance. So a debit subtracted from a credit gives us net income or net loss. So since this is smaller than the credit, this is going to be a net income. It's going to have a credit balance. And that kind of answers these 2 questions, so I'll leave you to that device. The next one looks at journalizing. So remember how we did increases and decreases? Well, we're going to swap that around now. Our first entry here is we paid a utilities expense of $300. Well, I know initially if I paid something, it's a cash. I've taken amount out of cash. If I want to decrease cash, I have to credit it. So that's $300. We know that expenses, come up here, have a debit balance, so I'm going to increase that utilities expense. And I just do an X here, just for the sake of not having to type it out. And it's going to be $300. Now, what has this done? Okay, I've created an account called utilities expense. I've increased it, and I've decreased my cash, which keeps us right in line with this accounting equation. The next one, you purchased equipment on account. I purchased equipment on account. Well, equipment is an asset, and we need to increase that asset by $2,000. We didn't use cash this time. We charged it. So you would increase accounts payable by $200. Is that making sense? Now, if you look at that and you follow that through all those transactions, what you're doing, instead of putting it in a matrix, like we did with everything else, like we've done before, we're now writing it in journal entry form and getting it ready to be utilized in the system, in the accounting system. And let's make sure our numbers are right. Check it with the handy-dandy guide here. So as you go down through here, see that? I put an extra 5 on there. Nobody said anything. So next, you're going to do accounts receivable. You've got, perform services for a client on account. When they say account, that means it's going to be, they didn't receive cash for it, but they charged it. So that's an accounts receivable. And obviously it's going to be accounts receivable debit and a revenue. What kind of balance does a revenue account have? It's going to be a credit. Kind of see how this flows? The next one you're looking at is they borrowed some money. They borrowed $10,000 cash and signed a note payable. Well, if they borrowed money, they got cash, correct? So cash gets credited or debited, And notes payable will get credited because it's a liability. That's how we increase it. If you look at what this is doing on the accounting equation, you can see we're just doing exactly what we did in the first activity, only we're calling them debits and credits. And we don't have that visual in front of us. So on the 19th, they sold $36,000 of land that cost the same amount. That means they didn't have a gain on it. So they got cash for $36,000, but their assets for land went down, so that would have to be credited. And I'll let you figure out the last two, but that's journalizing. That's how you journalize things. So if you move on, and we're now looking at 5, and 5 is, okay, this is step 1, journalizing. This would be step 2, where we're posting. This is posting to what they call T accounts. You see this T account, see the T, and it looks just like a T, and then this is the name of the account, and this is the account number. When you have posted all of the, or journalized all of these, then you transfer that information to accounts, and it's in a general ledger. This is an accountant's way of being very quick about it so that you can see the overall effect. So let me show you how this works. First of all, you're going to describe what each of these entries is and what it's doing. Such as the first one, August 1st. The business received $86,000 worth of cash, and they issued common stock. So that's somebody invested in the company. Investment of cash by the owner, okay? So you could just type that in, an investment by the owner. But what we want to look at is how does that affect the accounts down here? Well, I'm on the left-hand side. I'm on August 1st, and I am going to put $86,000 in my cash account. Now, we know we're in a double entry system, so I have to have both sides. So down here, I have to credit on August 1st that $86,000. So we are in balance. Doesn't seem to want to be cooperating with me. So there's $86,000. Maybe I need to expand that. Nope. You may have some interesting... So that would go there, and it's on the right-hand side. Now, the next one, they talk about purchasing supplies on accounts. Well, let's see. Where's my supplies? Well, I have to debit my supplies. Is that correct? And I have to find accounts payable. And I would credit it to add that to the account, $700. I'm not too sure how far over you're going to be able to, you're not going to be able to go too far with that. So that is the second transaction. Now we'll do one more. They paid $58,000 for a building. So instead of debiting cash now, we're taking cash out. So that's $58,000. It comes out. And where's our land? We should have land someplace. Supplies, accounts payable. How about buildings? So there's the building. Okay, I feel much better now. I need to credit the building. I've removed that. Okay? So I haven't removed it. I've bought it. I need to put it in. Excuse me. $58,000. So now, as you look at this, we've done 3 transactions. Here's a cash. Here is a capital. Both that's in balance, correct? We have on August Second, we purchased or we charged supplies, so there's a debit here and a credit here. And then on August 4th, we spent $58,000 for a building. So you go through all of the entire process here of all of these accounts, placing them in the correct. You always have to have two entries. One's going to be a debit, one's going to be a credit. When you get all of this finished, you're going to add up on August 31st and see what the balance is in each of these accounts. And then you will pull each of the balances off and create a trial balance to make sure everything is in balance. I've left the totals here that were already in the problem simply for you to use as making sure that you have the right amounts, just as check figures. So once you get this filled in, then you would take this and pull this all down to these accounts and put them in as debit balances or credit balances, whichever. They should total up and balance at $91,400. If you've done this correctly up here, that's what you will have. And one reason that you really do, the only reason you actually do a trial balance is to know that your accounts are in balance. So on 6 and 7 in the activity in this assignment, do not do them. I've just taken them out, and what we're going to do is take, and we'll do this in another video, we're going to take this trial balance and create income statements. So work on this, get it done, and then hop to the next video, and you will do only number 8. You will not do 6 and 7. Make sense?